Welcome to the Bullion Signal Podcast. We're the channel that cuts through the noise of daily market chatter to focus on the big picture, macroeconomics, precious metals, and most importantly, how you can protect and build your wealth in an increasingly uncertain world. If that sounds like something you value, make sure you're subscribed so you don't miss our future analysis. Now, today we're diving into a story that's unfolding right under our noses, largely ignored by the mainstream financial press. Something is fundamentally broken in the silver market. We're witnessing a disconnect between the paper price you see on your screen and the physical reality of the metal itself. And this isn't just a minor glitch. It's a structural tension that could be building towards a dramatic and possibly violent repricing event. Let's get right into the evidence.
Look at this number. It's not a crypto coin or a hot tech stock. No, this represents the recent spike in what's called the silver lease rate. Think of it as the interest rate that large institutions like banks and refineries have to pay to borrow physical silver bullion from each other. For years, this rate was practically zero, less than 0.5%. It was cheap and easy to get your hands on physical metal if you needed it. But recently, we've seen this rate explode, sometimes by well over 100%. This is the market's fire alarm. It's a flashing red light screaming that the supply of physical ready-to-deliver silver is becoming dangerously tight. It tells us that those who have the metal are refusing to let it go, even for what amounts to a massive return.
And that really brings us to the core mystery we're going to unravel today. Why? Why are the big players, the bullion banks, the refineries, the very entities at the heart of the market suddenly so reluctant to part with their physical bars? When someone is offering you crisis-level interest rates to borrow something and you still say no, it means you believe that asset is about to become far more valuable than any interest you could earn. It means you anticipate a shortage. So what do they see coming that the rest of us are missing? We're going to follow the trail of evidence from the vaults of New York to the factory floors of global industry to find out. To really understand the situation, you have to grasp a fundamental concept. There isn't just one silver market. In reality, there are two. And for decades, they've coexisted. But now, they're moving in opposite directions, and the strain is becoming unbearable. On one hand, you have the paper market. This is a world of digital contracts, futures, options, and ETFs, essentially promises for silver. On the other hand, you have the physical market. This is the real deal, actual silver coins and bars stored in vaults that you can touch and hold. The story we're exploring today is about the growing battle between the paper promise and the physical reality.
Now, the nerve center for the paper silver world is the COMEX, the commodity exchange in New York. This is where the global spot price of silver, the price you see quoted everywhere, is determined. But here's the dirty little secret of this market. The overwhelming majority of the trading that happens on the COMEX is for these paper contracts. It's a high-stakes game of passing around IOUs for silver, with very little physical metal ever changing hands. It's a pricing mechanism built on the assumption that the physical metal will always be there if someone actually asks for it. And that assumption is now being tested like never before.
Let's break down this conflict a little further. Paper silver, in the form of these contracts, can be created with a few keystrokes. You can sell a contract for silver you don't actually have in a practice known as naked short selling. In theory, the supply of paper claims can be almost infinite. And what happens when you have a nearly infinite supply of something? Its price is suppressed. It keeps the official price artificially low. But physical silver? Well, that's a different story. It has to be mined, refined, and transported. It exists in the real world. Its supply is absolutely, physically finite. And it's this physical scarcity that is now starting to overwhelm the paper illusion of abundance. Let's look at the hard data from the belly of the beast, the COMEX vaults themselves. The inventory that really matters is the registered category. This is the only silver that is fully available for delivery to settle a contract. After hitting a critically low point of just 30 million ounces in mid-2023, it has seen some recovery. But look at that number, 73 million ounces. It sounds enormous, right? But here's the terrifying context. That number represents less than 1 week of global industrial demand for silver. Let me repeat that.
The entire registered stockpile backing the global paper price of silver would be consumed by industry in less than 7 days. The vaults that are supposed to ensure market integrity are running on fumes. This extreme tightness in the physical market leads to a phenomenon that market veterans see as a major red alert. It's called backwardation. It sounds technical, but the concept is incredibly simple and powerful. All it means is that the price for getting a bar of silver in your hands right now is higher than the price of a contract that promises to deliver you a bar of silver in a few months. Think about that. Why would anyone pay more for something today than for that same thing tomorrow? The only answer is desperation. It signals an acute, immediate shortage where industrial users and investors are scrambling to get their hands on any physical metal they can find, and they're willing to pay a premium for it. So this begs the question, where did all the physical silver actually go? Who is draining these vaults and creating the shortage? This isn't a story about a few hedge funds or wealthy speculators trying to corner the market. The real driver of this squeeze is far more powerful and far more persistent. It's the relentless and, frankly, unstoppable march of global industrial and technological progress.
This chart lays it out perfectly. A massive 70% of all silver produced each year is consumed by industry. Silver isn't just a monetary metal like gold. It's the most electrically conductive, thermally conductive, and reflective metal on the planet. It is absolutely essential for solar panels, electric vehicles, 5G networks, artificial intelligence data centers, and critical military hardware. And here is the most important part of this story. Unlike investment gold, which is carefully hoarded and stored in vaults, this industrial silver is consumed. It's used in tiny amounts, embedded deep inside millions of products, and is almost never economically viable to recycle. It is, for all intents and purposes, gone forever.
This isn't a recent development. This has been building for years. According to official data from the Silver Institute, the world has been in a structural supply deficit for 7 years straight. Think about what that means. For 7 consecutive years, our global economy has used more physical silver than all the mines and all the recycling operations in the world could produce. For a while, we were able to fill that gap by drawing down the massive above-ground stockpiles that were built up over decades. But those stockpiles are now visibly dwindling. You can only drain the reservoir for so long before you hit bedrock.
And the scale of this deficit is staggering. Just since 2021, the cumulative shortfall between what the world needed and what it produced has surpassed 800 million ounces. That's a mind-boggling amount of physical silver. To put that in perspective, that's more than 25,000 metric tons of metal. This is the physical reality that the paper market has been able to ignore, but physical reality always wins in the end. A market can't defy the laws of supply and demand forever.
The obvious question is, if there's a shortage, why don't the mining companies just produce more? Well, it's not that simple. Here's another critical piece of the puzzle. Roughly 70% of the world's silver supply isn't produced from primary silver mines. It's actually a byproduct of mining for other industrial metals, primarily copper, lead, and zinc. This means that the amount of silver being produced is largely dependent on the global demand and economics for those other metals. You can't just decide to triple silver production tomorrow. The supply is what economists call inelastic. It can't respond quickly to price changes. This creates a dangerous bottleneck on the supply side.
Now, this kind of dangerous disconnect between a government or market promise and the underlying physical reality is not new. History is littered with examples of what happens when a paper pricing system finally breaks under the weight of physical demand. And these historical precedents give us a very clear roadmap for what could happen next.
Let's look at 2 classic examples. In 1971, the US dollar was officially pegged to gold at $35 an ounce. But when foreign countries came to redeem their dollars for physical gold, the US didn't have enough to honor its promise. So President Nixon closed the gold window, severing the dollar's last link to gold. What happened? Gold was set free. It exploded 2,400%, or 24 times, over the next 9 years. Then, in 1980, the Hunt brothers attempted to corner the physical silver market. They understood the leverage between physical supply and the paper price. Their buying spree forced the price from around $6 an ounce to over $50 in just a few months. Today's situation is different, but the fundamental principle is identical. Physical reality is reasserting its dominance over the paper price. But it's crucial to understand why today's situation is potentially even more powerful than the squeeze of 1980. The Hunt Brothers event was driven by speculation. It was an artificial attempt to corner the market by a few wealthy individuals. When the rules were changed against them, the corner collapsed. Today's squeeze is completely different. The primary driver isn't speculation. It's non-negotiable industrial demand from the largest corporations in the world that need silver to build their products. This isn't an artificial corner. It is a true, organic, structural shortage, and that makes it far more durable and potentially far more explosive.
So let's connect all the dots. We have critically low inventories in the vaults that are supposed to back the entire market. We have crisis-level borrowing costs signaling a desperate scramble for physical metal. We have an unyielding structural supply deficit that has been running for 7 years. And we have an unstoppable, ever-growing industrial demand that consumes silver for good. When you put all of this evidence together, it points to one inescapable conclusion. We are on the precipice of what could be called the Great Silver Repricing, the moment when the paper price is forced to snap back to physical reality.
And please, don't just take my word for it. This is not some fringe conspiracy theory. Some of the biggest names in finance and industry are starting to sound the alarm. Major institutions like BNP Paribas and Bank of America are now publishing research with price targets of over $100 an ounce. CEOs of major silver mining companies have stated publicly that a price of $100 or more is required just to incentivize the difficult and expensive process of finding and developing new mines to meet future demand. Well-known financial commentators like Robert Kiyosaki are calling for $75 silver in the near term. The smart money is waking up to the math. The signs of this repricing are not hidden. You can see the cracks forming in real time if you know where to look. First, as we discussed, the crisis-level lease rates. Second, look at the premiums on retail products like silver coins and small bars. They are consistently selling for prices far above the official spot price, which shows intense demand from the public. Third, we're hearing more and more reports from mints and bullion dealers about significant delays in delivering products. And finally, we will see the fourth step. The paper price on the COMEX will be forced to play catch-up, chasing the true physical price higher in a panic.
This analogy really captures the historical gravity of the moment we may be in. Before 1971, anyone could exchange $35 for an ounce of gold. It was a fixed price. After the paper promise was broken, that price vanished into history, never to be seen again. The argument being made by many market analysts today is that silver prices below, say, $50 an ounce represent a similar, fleeting opportunity, a chance to acquire a critical real asset at a price set by a paper regime that is visibly failing just before the market is forced to reprice it based on its true physical scarcity.
And so, that leaves us with the ultimate question that this entire situation hinges on. For the better part of 40 years, the price of a finite, critical, physical commodity has been dictated by a market trading a theoretically infinite supply of paper promises. All the evidence we've reviewed today suggests that this dynamic is breaking down under the immense pressure of a structural physical deficit. So what happens next? What happens when that paper price is finally dragged, kicking and screaming, to meet physical reality? History teaches us that when these moments of reckoning arrive, the adjustment is rarely calm, slow, or gradual. Thank you for joining us on the Bullion Signal Podcast. If you found this analysis valuable, please help us spread the word by liking this episode and sharing it with someone who needs to hear it. And of course, make sure you are subscribed for more deep dives into the signals that truly matter. Now for our disclaimer. Please remember, the content in this episode is for informational and educational purposes only. It should not be considered as financial or investment advice. You should always conduct your own thorough research and consult with a professional financial advisor before making any investment decisions. You and you alone are responsible for your own choices. We'll see you in the next episode.